Thank you. Good afternoon, everyone. I would like to call this meeting to order and acknowledge that we are in Treaty 1 territory, the home and traditional lands of the Ojibwe, Cree, and Dakota peoples, and in the national homeland of the Red River Métis. Our drinking water comes from Shoal Lake 40 First Nation in Treaty 3 territory. My name is Carrie Linklater, and I am the chairperson this afternoon, and I am joined via Zoom by Mr. Clay Purvis and Mr. Robert Kraus in person. From the assessment department is Mr. Nuwan Thudaglia, and our administrative personnel is Mr. Tristan Breeden. We will be hearing applications for revision of the assessment roll in accordance with the Municipal Assessment Act. The matters for which revision is requested have been described in each application, and we will limit discussion to those matters. Statements that are made at this hearing are sworn testimony, and anyone speaking to the matters must be sworn in. Be advised that comparisons of assessments of properties are not considered evidence of market value by the Board of Revision. The Board of Revision is appointed annually by City Council and is independent of it and the City Administration. It makes its decisions on the basis of the evidence provided at this hearing and issues a written order that will be mailed to all parties as soon as possible. Please note that the Board's decisions with respect to an application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to the Court of King's Bench if the matter pertains to the application of exemptions from taxation. Should you wish to appeal, information on how to do so will be included with the Board's order. With respect to the hearing process, I will confirm the points of appeal with your property to be addressed, with each applicant following the swearing in. We will then have the assessor's testimony followed by questions that the applicant may have, and then the applicant's testimony followed by questions. Each side will have an opportunity to summarize if they wish. Once all of the evidence about an application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all the applications have been heard, and the Board will deliberate in private and make its decisions. You will receive the Board's decision by registered mail as soon as possible. As information, all public hearings are live streamed, recorded, and will be part of the public record. This afternoon, we will be hearing items 2, 4, and 5 on the docket. And Mr. Breeden, please affirm the assessor and the applicant's testimony.
Mr. Assessor, please state your full name.
Nuwan Tudugala Munasingha.
Do you affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes, I do.
Thank you very much. Mr. Applicant, please stand. Please state your full name. Trevor Smith. Do you affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Please be seated. Thank you very much.
Thank you, Mr. Breeden. And good afternoon, Mr. Smith and Mr. Thudaglia. And whenever you are ready, Mr. Thudaglia, if you want to start us at our first item, number 2, at 3094 Pembina Highway, and we are looking at assessed value.
Thank you, Madam Chair. File number 244013, roll number 03040115000, 3094 Pembina Highway, roll year 2025, reference date April 1st, 2023, assessed value 5,001,000, classification 20 residential, liability taxable. This is a 4-story building, actual build year 2020, effective build year same, number of suite 24, that has outdoor parking 44. Page 2, you can see the location and aerial picture of the building. So, and the location is good. It's close proximity to UM, University of Manitoba. And page 3, you can see a request for income information, and also you can see subject property sale history. And page 4, income value summary. And the building has 9 one-bedroom and 15 two-bedrooms, altogether 24 units. Average monthly rent per unit, 1,338. You can see the gross potential rent. It's 385,589. We have used 3.1 vacancy rate, and we got effective gross income at 373,636, and we use 40.44 expense rate. So based on that, net operating income comes at 222,538. We have used a 4.45 capitalization rate. So estimated market value comes at 5,001,000. Market value per suite, 208,375. Page 5, you can see rent comparable. So those rent comparable supported model rent. Page 6, capitalization rates. So those are model driven capitalization rate. So you can see the multifamily capitalization rate, the high rise, low rise, and low rise A, low rise B, all 20% percentile, 4.75 to 5.45. Colliers, you can see 5 to 6, and CRB, you can see 4.75 to 5.25, and low rise 4.5 to 5.25, and low rise B 5 to 5.25. Cushman and Wakefield, low and high. For high rise, 4.75 to 5.5, and low rise 5 to 5.75. Page 7, you can see capitalization rate evidence. Those following is sample of actual sales that took place during the reference period. The purpose for showing these in individual capitalization rate is to illustrate the accuracy of the model and substantiate the model driven capitalization rate. They are not meant to be comparable specific to the subject property. The model capitalization rate for the subject property 4.45. This is like the build year 2021 with 24 units. So I believe 23 Mac Phillips Street, supported by the unit size and sorry, by the year, and 241 Yarn Street, supported by the unit count. So page 8, Municipal Assessment Act excerpt. In page 9, you can see exterior picture of the building. It's new building. And page 10, interior pictures. It's a good quality building, you can see. Also page 11 and I think page 11, page 12 and page 13, and page 14 I have added some sales. This is a 2022 market insight. The purpose of showing these sales to show the model generated assessed value in line with the market sales. This is not comparable to subject property. So in the below chart, you can see the sales price per unit. So these sales supported the assessed value of 208,375 per unit. So as per square footage, that's 206. So page 15 to 20, you can see income and expense information. Page 17 and 18, 19. And page 21, sorry, income and expense stabilization table. I have used their actual income and expense to stabilize in here, and you can see the model in NOI supported by their actual. So I believe the 5,001,000 is fair value for the property. This concludes my presentation. Thank you.
Thank you very much. Mr. Smith, any questions to the assessor?
Yes, thank you, Madam Chair. Let's start on page 21 of your brief.
Sure. 21. Yes.
You've done the stabilization.
Yeah.
So when we look at the 2022 expenses column, you've totaled that at $132,239. When you do the math and add those up, it actually comes to $169,560.
Okay. I think I missed somehow I missed it.
Okay, would that impact your stabilization?
Well,
so have to, right?
I think you can see the that stabilization number is 151,555 for expenses, right? So that means if you are checking by one, I think the problem in here just the total.
Okay,
right.
I'll move on from that. I don't want to delay us unnecessarily. The city, of course, is aware that 2021 was a partial year of operation and that the expenses shown there wouldn't represent the total expenses for property on a fully occupied basis and would therefore underestimate what the expenses would be.
Yeah, that's right. But like that's why I had to compare the sales. So to show this is our assessment is in line with the market value.
Right.
So
okay. Final point on that page, in the stabilization, you have used 0% vacancy in doing the stabilization. Is that a typical methodology in determining value, not to assign any vacancy?
In there, you can see what they are reported. That means 5% in 2022 column. So that's what they reported in actual income and expense mailer. So
yes, yes, my question is more with regard to methodology rather than a single year in the first year of full operation of a new building when it's attractive. Is it typical to assign no vacancy in doing a stabilization?
Not really, because we have to add some vacancy, but in here they reported the actual income. So basically what happened, their income increased year by year. So they reported actual income, so I used the actual one. So that's what happened.
Okay, that's fine. Let's move on from there. So capitalization rate that is used by the city, this is model driven, I'm assuming, 4.45%.
Yes.
Yes, okay. When we look at the page 6, the multifamily capitalization rates that the city has here, this would be a low-rise building, correct?
Yes.
So the 4.45% is below the 20th percentile of the city's, basically the city's low end of the 20th to 80th percentile. Is this the lowest capitalization rate the city uses, or?
I can't exactly say, but this is the bell curve, right? I mean, so that 20 percentile, you are talking about 20 percentile. Less than that could be like a higher, I mean, lower capitalization rate. So this is one of that maybe might be.
Would you agree that the 4.45 is well below the main commercial brokerage's low end of cap rates for low-rise buildings?
As per information, yes.
Okay, moving on to page 7 then. So you brought up 2 properties, Young Street, that's in West Broadway, correct? So not really much of a comparable. Would that be fair to say?
And as per unit count, it's comparable. So that's why I said it's per unit count. The 23 Mac Phillips, it's like for the year. So yeah, that's my perspective. I mean,
Okay, that's fine. And then you mentioned again 2390 McPhillips, which is the most recent build, 2015. And the city has a cap rate of 4.71% on it. We have a cap rate of 5.0% on it. Would you agree again that your cap rate is well below the sale of the most recently built apartment building in the city?
I think maybe the cap rate difference should be we stabilize with the 3-year income and expense information. Maybe you might not stabilize with 3-year. That could be the difference.
That wasn't my question, though. My question was, is the cap rate that the city is using for the property, 4.45%, well below the capitalization rate that we both have, while they're somewhat different, well below the capitalization rate for the most recent transaction of a newly built apartment in the city, 2390 McPhillips?
I'm not sure about that. I don't know.
It's 4.45% lower than 4.71% or whatever it is that the city has.
Yeah, that's lower.
Okay, those are, I have one more point, sorry, quickly, I deal with most of the questions on the first one here. Page 14, you've got Winnipeg multifamily top sale transactions. The first one, Lumen at South Point. Is the city aware that this is a townhome development?
Yeah, first, yeah, I don't mention first one, so I'm like mentioning second one and third one, and third one in the picture, and I have added another one. Third one is different. That's not in the picture. I know the first one is townhouse. Yeah.
Okay, and did the city do the background check with the vendor and purchaser as to details of the transaction?
As I said, this is like ballpark figure to show this is our assessment is in line with the sales. So we didn't, yeah.
Okay, I don't have it in my evidence, Madam Chair, but I'm going to speak to that one briefly when I get to it. Those are all of my questions. Thank you.
I thank you both. Mr. Kraus, any questions to the assessor?
I have no questions right now. Thank you.
Thank you. And Mr. Purvis?
I think all of my questions have already been asked. Thank you.
Thank you. I just have a couple of brief questions. So I understand your cap rate is model driven. So is your whole brief model driven on this property?
Yes, ma'am.
Okay, thank you. Also on page 5 of your brief, just gonna scroll to it. Your rent comparables. So your 4 comparables are all much bigger in terms of actual units, correct?
Yes, these are the best I can find like within the year. That means build year. So that's the reason. I mean, I could find some the oldest, but yeah, that's the reason I found this one. Yeah, you're right.
All right. So did you select them then on age?
Yes.
All right. And this is a new building. Has this been inspected?
Good question. I need to find. As I remember the information, yes. This one inspected when they add into the draw.
Okay, thank you. Just one last question in regards to the vacancy. You've got a model-driven vacancy rate of 3.10, correct? On page 4 of your brief?
Yes, 3.1. Yeah.
Yeah. Oh, sorry, 3.1. Yes. So this being a new building, did you consider at all that new buildings have a lease-up period? So they
Yes.
experience some vacancy?
Yes, that's right. But this is near to the university. And also you can see their actuals in the 2022. They are doing pretty good, I think. Yeah, that's the answer for that question.
All right, thank you. Mr. Applicant, if you would like to proceed with your brief, please.
Thank you, Madam Chair. So just quickly, as I mentioned, the city had brought up the sale of Lumen at South Point in their evidence on their page 14, and I queried whether they'd had the discussion with the owner and purchaser. So I do work for the vendor of that property and had this discussion with them. The transaction was done with the purchaser intending to sell eventually the units off as condominiums in the marketplace. It's under a condominium structure, so they were willing to pay an above market purchase price for the property on the basis that they would then significantly increase their return by turning those into individual condominiums that they would sell on the market. So the price per unit, price per square foot, etc., is well above market for properties such as that. That's what I was getting at with that particular transaction. I'll delve into our brief here now. Just to keep things as brief as possible, we're not in great disagreement on the rental income. The actual rent is slightly under what the city has projected, but then when you take parking income into account, it's the gross potential income is slightly above what was projected by the city. So we have no great argument in that regard. Just to clarify that to begin with. Jump into the brief here. Built in 2020, finished in 2021, I believe, slightly. The property has a total of 24 units, as already mentioned, 15 2-beds, 9 1-bedroom units, and it is shown on the following pages. We have inspected the property. The photos are there for you to see. It is a new build, so this is what your typical new build of this rental level will look like in the market. The site, if you look at page number 8 and 9, so number 9 will give you the map view. It is south of Dalhousie there, between Dalhousie and the perimeter. And if you're familiar with this area, that used to be a service garage that was on site there. Property was purchased, that was demolished, and the apartment building was constructed on that site. So it's out near the end of Pembina Highway. Yes, the University of Manitoba is in the vicinity, in that it is in Fort Richmond, but it's not exactly close to where the subject property is. It's a decent location. I wouldn't call it any better than that. In fact, the property to the south of this is a Manitoba Housing location, which I have valued in the past as well. So let's move forward into the valuation itself. I give you on my page number 11, in first full year of operation, 2022, the subject had a gross potential rental revenue of $378,643, which gives you an average rent of $1,315 per unit per month. CMHC stats are there. Back it up, as well as some market rent comparables on the following page. These are all new build properties in the city of Winnipeg that support the rental rate level. So we're going with the in-place rental rate as backed up by the marketplace. To that, we add the parking revenue of $18,475 in our analysis. So that takes us above the gross potential rent that the city has projected for the property. On a vacancy basis, sorry, there's text in here that refers to a different property. My apologies for that. So yes, 2022 was the first year of operation, but it did not have a 62% vacancy rate. It did begin operations in 2021, and as is typical with not all but many new builds, there's kind of a honeymoon period where the building is brand new. People like to move into a new unit, and you typically, there is that lease up period where it goes from 0 to 100% occupancy. They do tend to fill up, certainly. And then you have, at the end of that, you tend to have people moving out and shifting around as they realize they're paying rent that they don't necessarily want to pay. They've had the new unit for that initial period, and then they move out. So there's turnover that happens. So the fact that the property had a very low vacancy rate in this one particular year does not mean that it will not have vacancy in a going forward basis. All properties have vacancy to some level, and you have to allow for that in valuing the property. So a single year does not make the value. Looking at apartments that rent for $1,300 per month and above, such as the subject, on my page 13 at the bottom of the page, you can see 1-bedroom vacancy was 4.3%, 2-bedroom was 3%, overall average of 3.3%. So similar stats for the year of construction, 2005, and more recent, 4% and 3.2%. So it is essentially framing the city's vacancy rate of 3.1%. So we are in agreement with that. We have utilized that as our vacancy allowance. The actual expense allowance, so the 2021 year that was reported to the city, again, only references a partial year of operation. So you have $101,000 of expenses or whatever the figure was. That's only a partial year of operation. First full year of operation, 2022, as I had stated earlier, has $169,560 of expenses, which equates to 42.75% of effective gross income. Slightly higher than what the city has projected, but certainly in line with the marketplace. So you can't effectively do a stabilization on this property as there's really only one full year of occupancy. So we, as it is within the normal range for a property of this type, we have used the actual expenses of $169,560. Moving on to capitalization rate. We have essentially two phases here. We have our own capitalization rate study as shown in the charts on page 15. And then we have the main commercial brokerages information following that, as well as a statement with regard to interest rates and mortgage lending rates. So let's look at the two charts on my page number 15. These are all transactions of apartment buildings in the city of Winnipeg as of the sale dates noted based on the in-place income and expense. And yes, they are stabilized. If you look at the range of capitalization rates here, obviously there is a range. The very lowest ones, which tend to be for properties that are going to be improved, are slightly under 5% and typically smaller number of units, such as 9 units on Thomas Berry or Tebow Street. What's the other one? I'm not even seeing it now. Anyway, the kind of standard range that we are looking at is a low end typically of 5%. Up to a high end of 6%. You do get outliers, obviously, that are on either side of that, but the main market falls within those ranges. Now, the only real transaction outside of, well, there's two transactions in that represent relatively newly built properties. Number 3 on my chart is 2390 McPhillips. The city has referred to this in their material as well. When you do the math and the calculation and the stabilization on this transaction, it actually comes out to a capitalization rate of 5%, 5.0%, based on the actuals of the property. The other more recent 100 Southview is actually the sale of the Lumen townhomes. And that again was purchased with the intent to sell off the individual condo units for significantly greater return to the purchaser. So the cap rate is not really representative of the actual cap rate for the property as an operating entity, as they were willing to pay above market rate for that. So your very low end is 5% up to typically 6%. There's also a few on page number 16. So that is what we see in the marketplace. Moving on to the main commercial brokerages, Colliers is shown on page 17. I've given you a 3-cycle history of cap rates that they quote, all in that 5 to 6% overall range. They have actually adjusted that for 2023 based on mortgage lending rates and interest rates after they made their publication. This is now 5.5% to 6.5% for Colliers for the 2023 year. Moving on to page 18, we have Cushman & Wakefield's Canadian cap rate survey for 2023 Q1, and they're stating low rises from a range of 5% to 5.75%. The other thing I will point out is the text in bold on my page 18. Bank of Canada interest rates rose from 0.5% in the spring of 2022 to 4.75% as of the valuation date of April 1, 2023. This is essentially a historic rise in interest rates, 4% over a one-year time span. That has obviously a direct impact on mortgage lending rates. They move upward along with the interest rates. It's not a one-to-one necessarily, but the rates certainly rose quite dramatically over that time frame. So if you were to look at purchasing the same property in 2022 in the spring versus April 1, 2023, your cost of borrowing will have gone up dramatically, which means that your return for the same property, same income stream will have gone down, and you'll be willing to pay less for that property, which would drive up the capitalization rate. That's exactly how the market functions. So 5% is really 5.25% in the marketplace as of the valuation date. If you look at the sales transactions that we have, none of them are shown to be in late 2022 because there were essentially no transactions. The market was shut down essentially by this significant change in mortgage lending rates. So we have made an adjustment essentially from 5 to 5.25% at the lowest end of the range for our valuation. So page number 19 gives you this background using the in-place rental, in-place income, standard vacancy, the actual expenses, and 5.25% cap rate. We come to a market value of $4.1 million. In the addenda materials, you have the income and expense from the relevant year. And I have also provided, the right ones are here. Also provided some decisions from the current cycle indicating the board utilizing capitalization rates for new build properties of 5.15%. If you look at my page A-10 and 11 onwards, all of these are new build apartments, and the decisions are there for you to see. That is my presentation. I'm happy to answer questions. Thank you.
Thank you. Any questions for the applicant? Mr. Assessor.
Mr. Trevor, how many sales in your capitalization calculation?
How many sales
You utilize to calculate your capitalizations?
Well, I think I'm understanding your question, and that you're wondering if I've done like an averaging or something as the city does in the assessments fashion. I don't do that. That's not how it's done. We look at what the market transactions are, and we make the most appropriate selections with regard to the ones that best represent transactions that are most similar to the subject property, and will inform selecting of that cap rate. So the charts on page 15, we have 15 and then 7. So we're looking at 22 sales. But again, we're not taking 22 sales, running them through a statistical package and getting 5.25%. That's not what is done.
Okay, thank you. That's all my question.
Thank you. Mr. Purvis, any questions?
Yeah, thank you, Mr. Smith. This is a question I probably could have asked the assessor as well. Just to be clear, a 4-story building, when we're looking at the cap rate stays with high rise versus low rise, 4-story would be considered a low rise?
Yes.
Or is that
It would be a low rise, yes.
Okay, so I'm assuming that that distinction sort of like I'm just curious when does a low rise become a high rise? Like,
Well, so modern building techniques, so they're typically building four levels now with the regulations with regard to how the structures can be built. High rise, you'd have to have there's not a hard cutoff, but I think you'd be 6 and above, certainly. Typically, either towers or your older blocks that are in that 10-story range, things of that nature.
okay, so like the 4-story, sort of all those 3-story buildings you see around Winnipeg, those are now, when they're being built now, would be 4 stories. It's sort of a
Yeah, rather than like 3-story walk-ups, they build
4-story.
4 stories now. Yes.
Okay. And also just when it comes to the cap rate, because I think this issue is the issue on all 3 of the of today's appeals. Does the newness of these buildings, do you think that has a positive or a negative impact on cap rate? Like, is it cap rate typically going to be higher or lower with a new build or a newer?
Right. So I guess there's a couple of things that go into that. Certainly being new is good from the perspective that you will have less to fix typically, in that your outlay on repairs and maintenance will typically be less initially for a period of time before that reaches a normal level as the property ages a bit. That being said, I do have owners that have purchased new build properties that then have issues that they did not know about when they purchased them that require investment. However, new is good from the perspective of typically it is attractive to the marketplace, as I had mentioned. So you do get people wanting to move in that. From the downside, the rent does tend to be more for a property such as that versus maybe the average for the area. So people don't necessarily, not everybody will have the ability to pay that. And those that do don't necessarily want to pay it for the long term either. So you do certainly get higher vacancy, as you can see from the statistics, than you would get in your normal, typical 3-story walk-up, things of that nature. On another perspective, if you have a new building, you can't really change it. In fact, in that you can't invest into those units and increase the rent. They're already at the maximum because it's a brand new building. So what you're buying is what you're getting. There's no upside, essentially. You can't convert it and get a greater revenue stream and increase your return. So it's like a bond, essentially, but that doesn't mean that it generates sub-5 capitalization rates. The market doesn't show that. There's really only one real transaction out there, and when you do the math on it, it's at a 5% cap rate.
Thanks. That's all my questions.
Thank you.
Thank you. And Mr. Kraus.
Yeah, just going back to the 2390 McPhillips that you and the assessor both brought up. Can you explain to me, so the assessor has it as a 4.71 cap rate and you have it as a 5.0 cap rate.
Yes.
And can you explain why the difference in, like, how did you come to a 5%? Just to explain that. Yeah.
So I can't explain what the city's done. I'm sure that they've done their due diligence, but they have a perspective in looking at it that is obviously different. What the market does in looking at these, and I'm sure you've heard from other agents the same thing on the same property likely. We look at 3-year history of the property. We do the stabilization with regard to the income stream and the expenses, what a typical operating vacancy rate would be, and develop the capitalization rate from that process. Yes.
Okay, thank you.
Thank you. I have no questions, but Mr. Smith, I am going to point out, you mentioned you have included in your brief previous board orders.
That is correct, yes.
Right. And I'm just pointing out, the panel will not be considering those. We did not sit on those panels. We were not there for any of the information concerning those properties. So thank you. Does either party have a wish for a summation?
No, thanks.
No, that's fine. Thank you, Madam Chair.
All right. We will move on to item number 4, which is 920 Chancellor Drive. Again, we are looking at assessed value. And Mr. Assessor, whenever you're ready to begin.
Thank you, Madam Chair. Sorry. File number 244026, roll number 03091643300, 920 Chancellor Drive, roll year 2025, reference date April 1st, 2023, assessed value 19,266,000, classification 20 residential, liability taxable. I have to mention here, this is assisted living facility. For assisted living facility, normally their rents are lower than a market because they have some entrance fee kind of thing. So because of that, and also they have like different services. So the expenses are not normal for the normal kind of apartment. So expenses could be high, and those expenses should be in the day-to-day expenses. So therefore, we consider this kind of property as a normal market apartment. This building has this is 5-story building, and actual build year 2021, number of suites 98. This has 28 indoor parking and 77 outdoor parking. Page 2, you can see the location and aerial picture of the building. This is also close proximity to the University of Manitoba, and also close proximity to the Victoria Hospital, and also a lot of grocery stores nearby. Page 3, request for income information, and also you can see the subject property sale history there. Page 4, income value summary. This one has 59 one-bedrooms and 39 two-bedrooms, in total 98 units. Average monthly per unit 1,335. Gross potential rent 1,571,007. Vacancy rate 3.1. Effective gross income 1,522,306. We have used 38.62% expense ratio, and net operating income comes at 934,391. We have used 4.85 capitalization rate. Based on that, estimated market value comes around 19,266,000. Market value per suite 196,591. And page 5, you can see rent comparable. So rent comparable support model rent. Page 6, you can see CMC calculation. In here, I calculate to compare potential rent to market rent. Actually, it's in line with the market rent. And page 8, the same information of which I explained last time. So you can see that like the urban square and UC30, those and also I have added another sale, that's the third sales. All sales supported our unit price, price per unit. So basically what I am showing here, this assessed value is in line with the market. This is not the direct comparison to the subject property. So page 9, comparable, capitalization rate. Those are a model-driven capitalization rate. I'm not going to like explain the whole thing because I explained that one previously. So capitalization, page 10, capitalization rate evidence. You can see capitalization rate evidence, and subject property has 98 unit, and building was built in 2021. So I believe 2390 Mac Phillips supported our model capitalization rate. Page 11, Municipal Assessment Act excerpt, and page 12 and 13, this is the actual cost of construction. The cost of construction 19,863,836. That's cost in 2021, and this is also without land value. So, and page 14, you can see exterior picture of the building. And page 3, you can see what kind of amenities they have, and page 16 and page 17 too. Page 18 and page 19, you can see interior picture of the building. It's a good and high quality building. And page 21, CMHC rent chart, and page 23, income and expense information. In page 24, you can see they have like a residential service 1. So those kind of services income there. That means they have like a different income source, and also if they have different income source, they should have different expenses too. So that's why we don't use their income and expense information. So I believe 19,266,000 is fair value for the property. This concludes my presentation. Thank you.
Thank you. Mr. Smith, any questions?
Yes, thank you, Madam Chair. Just a few. So, Yuan, I think you had you stated that the rents in assisted living are typically lower than market. Is that what you had said at the beginning of your presentation?
Yes.
For assisted living.
Yeah, I said that sometime it's maybe higher because it's not market. That's what I want to mention. So
we're in agreement that it's not market, but assisted living rents are typically significantly higher because they take into account the services that are provided to the tenants, such as meals, housekeeping, all of the additional services that they provide in these facilities. I just wanted to understand where you were coming from on that one, but we are in agreement that they are not at market. So you have on page 13 included the developer's response to the city with regard to construction costs and it's 19.8 million. Is the city saying that the cost to construct is essentially your cost approach, and that is what the market value of the property is? It costs this to build, therefore it's worth that amount?
Like basically, in theory, we have like cost approach, market approach, and income approach should be equal. But so in here, I'm not saying because normally when we are calculating cost, it's lower than the income approach, normally the value. So but I'm here, what I'm saying, this is like 2021 value, and also without land. And so this is like, again, a ballpark to our assessment value. So and another thing, like normally this kind of investment, the investor, this kind of how I explain it, sorry. Normally good investor don't invest in this kind of apartment if they are not profitable. So basically they know they can get more than this. So I mean, not more than this mean the return for this investment, right? So that's what also I have to mention here. So yeah, that's basically it.
Okay, those are all of my questions. Thank you.
Thank you. Mr. Kraus.
Just with the rent comparables that you have on page 5, are those all retirement senior housing as well, or are those just general rent comparables?
Those are just general rent comparables.
Thank you. That's all I have.
Thank you. And Mr. Purvis?
I don't have any questions.
I just have one question. Your brief was all model driven, correct?
Yes, ma'am.
Thank you. Mr. Applicant, if you would like to proceed with your brief, please.
Okay, thank you, Madam Chair. So just 2 points of clarification to start with. The issue of the cost to construct. The city's included the costs that were supplied by the developer on their page 13. So these properties are valued on the income basis, and as they should be. And the issue of cost to construct and permit values and all of this always comes up. So I always feel the need to address it. The developer of the property builds the property. It costs a certain amount to build. That does not translate into one-to-one. That's what the value of your property is. It's expensive to build things these days, as we all know. And the developer and owner of the property, they finance both that construction and the mortgage of the property over an extended period of time. They make their projections of what their income and expenses will be over that time, and they generate their return on the operation of that building. There is no direct translation of what it individually costs to build that building on day one to what the market value of that building is. So to put this in and say, well, it's 19.8 without the land, therefore 19.8 is reasonable, that's not an accurate statement. Secondly, assisted living facilities, which this is not a life lease facility, it's an assisted living facility, provide extensive services to their occupants and tenants. That's 2 to 3 meals a day. That's housekeeping. That's trips to the grocery store. That's in residence activities that they provide. There's any number of services. I'm sure it's here in the city's presentation what they provide, and all of that costs money. Therefore, the amount that they pay is well above what you see for a standard market apartment for rent, because it includes all of those services, which obviously have a cost. So yes, we are in agreement with the city that you cannot value the property on its standard operation, because it's a business, kind of like a hotel is, in that you can't base the real estate value of the property on the operation of that assisted living business. So the way to value these is to strip out that business component, which is what the city and ourselves do and have done for many cycles. You take out the above market rental income and apply normal market rents to the property. This is what it theoretically would rent for on the marketplace. And you look at the expenses and strip out any expenses that would be above a typical operation for a normal apartment building, taking into account that there's a lot more common area space in these facilities than there is in a standard market apartment that needs to be heated, cleaned, etc. That space doesn't disappear, and it does mean there are greater costs than there are for a standard building. But, you know, operating the kitchen, etc., those are costs that are kind of above and beyond the norm. So that's the background, that's the methodology that these are based on. And we can delve into this particular property. So 920 Chancellor, obviously it is in Southwest Winnipeg, just off of Pembina Highway. I'll situate you if you flip forward to my page number 11 and 12. 12 will give you the aerial view. So it is just south of Abinogi-Mikina on the south side of south side of Chancellor, just to the west of Pembina Highway, in behind the strip mall that is there at Chancellor and Pembina. So if you flip back a page to number 11, you can see the strip mall and the odd little piece of land that was located in behind that. That is what was purchased by the developer, and that is where they built this particular site. So it's a bit of an odd location. Assisted living occupants are obviously 55 plus, typically considerably more than that. So the location of the U of M doesn't have much bearing on the valuation of the property. So let's skip backwards briefly. Built in 2021, you can see the unit counts there. So really the division here is as shown on my page, which I believe is somewhat different what the city has said. City has 59 one bedrooms and 39 two bedrooms. In actuality, it's 20 studio apartments, 58 one bedrooms and 22 bedroom apartments is the actual breakout of the property. I've inspected it and that confirmed it with property management, and that is what the actual count for the property is. So needless to say, that would have an impact on the overall projection. The studio units and half of the one bedroom units are designed with shared kitchenettes and laundry facilities, which we'll show in the photos. So they don't actually have their own kitchenette, not full kitchen. They have a shared one that between two individual units. Typically, these units are somewhat smaller than a standard market apartment as well. So the property was also in the lease-up period and had a vacancy rate of 62% as of the valuation date, 61 out of 98 units being vacant. Moving forward, photos on page 4, some of the exterior, then you move into the building itself, some of the common areas, dining room at the bottom of page 5, some exterior on 6, and then we get into the units themselves. Again, typically, and there is some variation in that the builder allowed for, different stages of one's life in the units that are being built in relation to the kitchen facilities that are provided. Being an assisted living center, they allowed for wider doorways. The bathroom facilities typically are designed with limited mobility in mind. So bathtubs, showers, circulation, things of that nature. So again, somewhat different than standard market apartments. Page 8, you can see one of the units that does have more of a full kitchen. You can see it's kind of apartment size, but it does have a fridge and a range. But as I said, there is a significant mixture between having a full kitchen and just having a kitchenette, which we'll show here as well. So jump forward to page 10 and you can see one of the shared kitchenettes. So you're essentially looking at a bar fridge, a microwave, and a sink along with some storage in those particular units. So not a full kitchen as one would see in a standard market apartment. Anyway, jumping forward, page 13. Seniors market rental apartments has essentially got 4 categories. You have number 1, 55 plus rental, standard market apartment, just limited to 55 plus renters. You have independent living, then you have assisted living, which has a somewhat greater degree of oversight than independent living. And then obviously retirement homes, personal care projects. You can skip forward into the actual valuation on page number 14. So I will say ultimately we're not in disagreement with the rental rate the city has applied, but I do give you background on it. Obviously, we can't use the in-place rents as they're going to be well above market. It was only began operation in 2022. We give you some CMHC averages as well as some newer built properties and their rental rates as shown on page 15. And they do essentially corroborate the numbers that the city has. Now, I would suggest to you that the city's model, given that they don't have any breakout of the studio units, would probably slightly overestimate what the revenue generation for the property would be. But ultimately, we are not opposing the rent that is applied to the property. Moving on to page 16, vacancy. As we stated, they're in a period of lease up. They had 62% vacancy, 61 of 98. Obviously, you can't use that in valuation, and that would be unfair. But what we can say is that they had a considerably slower than standard lease up for this type of property. The owners are quite concerned about it. And what I can tell you is that there's a lot of competition out there for this particular category. And this particular location was not one, I guess, that was highly valued by potential tenants. Same stats for rents above $1,300 and newer built apartments are there, showing you that vacancies are higher at 3.1%. What we have done in our valuation is we have deferred to the city's vacancy rate of 3.1%, but we are pointing out that vacancy is an issue here. They do have a slower lease up, and it is likely that they will have a greater vacancy rate going forward. So we take that increased vacancy risk into account as one of the factors in the selection of the capitalization rate, consistent with appraisal theory. Moving on, expense allowance, 2022 was the first year of operation, wasn't a full year, so we don't have any real basis to put forward an actual expense amount for the subject. So in this instance, we've deferred to the city's 38.62% estimate for the expenses. Now we can move into capitalization rate. This is our great point of dispute, and it is critical. What I can tell you, and you're free to look at them or not look at them. I have represented a number of assisted living facilities for many cycles, including this cycle, and the capitalization rates that we have used in valuing them have been significantly higher than what the city uses and have been decided typically on that basis. That information for you is in our addenda. It's representing numbers 475 and 490 Linden Woods. We used a 6% cap rate, and that is the basis that the properties were decided on. Anyway, moving forward, discussion of cap rate beginning on page number 18. So this is where we diverge from the city as far as how these properties would be valued. So the city says, let's value it entirely as an apartment, standard market apartment. That's their position. That's fine. Well, this is where it changes. It's physically not a standard market apartment. And if it were to transact on the marketplace, it would not transact as a standard market apartment. It would, well, it would sell as an assisted living facility, which is an entirely different thing. We can't use those cap rates as they value the business. But if it were to sell, theoretically sell on the marketplace as a standard market apartment, well, how would that look in the real world? So you as an astute investor would look at the purchase of this property. You have an assisted living facility that you want to turn into a market apartment, rent it out as such. You have all of these tenants that are in there as is, expecting their services and legally entitled to the services based on the leases that they've signed going forward until they no longer occupy those units. So that would take a considerable period of time to convert it to a normal apartment as those occupants vacate for various reasons. So that would have a major impact on your return, obviously right there. Who knows how long that would take, multiple years, obviously. You have the expenses that are involved for that property that are above normal because, well, again, taking the business out of it, you have essentially an entire floor that you have to maintain that doesn't generate any revenue for you as a market apartment. You have the all of those common areas, such as you've got the kitchen, you've got the dining room, you've got the meeting rooms, you've got the exercise room, you've got the lounge, you've got, it goes on and on. There's a lot of space that contributes to additional costs for these facilities. Beyond that, doing work for a number of operators of these facilities, there is more wear and tear, surprisingly, in many of these facilities than you see in a typical market apartment because of mobility issues and walkers and canes, etc. There's a lot of repainting that goes on that you don't necessarily have to the same degree in a standard market apartment. Anyway, so looking at all of that, apples to apples, standard market apartment versus an assisted living facility that you're going to buy as a standard market apartment, you're going to use a higher cap rate, considerably higher cap rate on the assisted living facility for all of the risk that you're taking on in buying this non-standard product in order to make it a standard market apartment. It's actually a very significant risk. So to that end, my page number 18, this will carry forward to the next property as well. So I'll only say it once. Business component. The business component of the property type would be expected to increase the risk inherent in the investment, should be reflected in a premium over cap rates for more conventional asset investments. In addition, it must be recognized the marketplace for tenants in these facilities is limited to 75 plus, typically age cohort. That's typically who is moving into these particular facilities. And within that cohort, those that have the ability to pay $2,500 plus in order to occupy their units, that's kind of a typical point. Middle of page 18, I referred to an article in the Canadian Property Valuation titled Valuation of Seniors Housing. If you look at the graph in the middle of the page, it gives you some insight into cap rates for different types of seniors housing. Now, this is historical in nature, so the actual cap rates are irrelevant. It's the spread between them that we're looking at essentially. So if you look at the levels there, apartment high rise A, so a standard market apartment is your black line at the bottom. Then you go into seniors housing A, which would be essentially 55 plus housing. You have a higher cap rate there. And then you have care facilities at the very top. So again, another premium on top of that. So it's the gap in between that we're looking at, not the actual capitalization rates as it's historical in nature. Equally historical from that same time frame, CB Richard Ellis had a survey of the main participants in that marketplace. What cap rate would they use for a Class A independent living facility? The results are shown on page number 19. And those are for obviously larger markets than ours. So typically we would see cap rates that would be higher than that for our particular location. Now, again, in the middle of page 19, and this is current, CB Richard Ellis published a Canadian Investor Sentiment Survey for 2023. In which investors were asked about their outlook on seniors housing cap rates for 2023. Only 5% of respondents foresaw no change in cap rates for 2023, with the remainder of respondents seeing between a 0.25 and 0.75 basis point increase in cap rates for this asset class. So essentially, everybody is saying cap rates are going to increase for this particular asset class. So that is background with regard to cap rates for this particular type of property. Now, we can move forward into the information we've already reviewed in our prior property. These are transactions of standard market apartments in our city. As we've already said, there'd be a significant premium that would be placed on the purchase of a property such as this assisted living facility in relation to what this range is. So our range here is generally 5 to 6%. 5% being the very low end, 6% being the top end. When we look at the main brokerages, Colliers was saying 6 to 6.5, which they changed to 6.5, or rather 5.5 to 6.5 for their 2023 timeframe. For again, standard market apartments. So move forward, CB Richard Ellis, 4.75% to 5.5%. They were stating for high rises, which this is not, and then 5 to 5.75% again for low rise standard market apartments. Cushman Wakefield at the bottom of page 2022 is seeing a cap rate range of 6.5 to 7.25% for seniors housing A and 8 to 9% for seniors housing B. Now, subject property is an assisted living facility. We can't value it as an assisted living facility as we'd be valuing the business, which needs to be stripped out. So we need to view it as a standard market apartment. But this is the significant point of divergence here. It's not a standard market apartment. You're taking on an enormous risk in buying that. If you approached your bank or mortgage broker to finance this on the basis of buying it as such, they would apply a very significant premium to the mortgage lending rate that they would give you in order to acquire a facility such as this, which would change your cap rate upwards dramatically as well. So everything is pointing towards a significantly higher capitalization rate than a standard market apartment. Now, take the ranges that we're looking at here, 5% to 6.5%, essentially, for standard market apartments. We have the very significant rise in mortgage lending rates as of the valuation date. We have gone to what we see as a very reasonable point within that range of 6% as in selecting our capitalization rate. We recognize that the property is new and that it has these amenities. That is all balanced with the fact that they seem to have significant difficulties in leasing this property up, which is somewhat location-based, as well as all the discussion regarding what an appropriate cap rate would be for this type of facility. So we have used a 6% cap rate in our valuation. And if you flip forward to page 24, you can see the summary of this. So I'll run through it quickly. We're not, again, necessarily disputing the rental income projected for the property. I would point out that the city has an incorrect division of units in that there are 20 studio apartments in this facility, so that would probably drive that number down. Vacancy rate, well, they have significantly greater, obviously, during the lease up period, but they also have an issue with leasing it up, so that might be somewhat aggressive, but we are deferring to the 3.1%. The expense allowance, typically, this would be higher. We don't have, unfortunately, a full year of operation that would give us any guidance as to be able to show that. You'll see it in the next property, but this one, we don't have that information. So in this case, we are deferring to the city's percentage in estimating the expense allowance. Capping the NOI at 6% gives us our market value of $15,573,000. And as I've already mentioned, I do handle a number of these facilities. They've all been heard already and decided at a 6% cap rate. That information is in the addenda. That is my presentation, and I'm happy to answer any questions.
Thank you. Any questions, Mr. Assessor?
One question. So your estimation is 15,573,000. So do you think the owner is willing to sell that one on reference date of April 2023? That means less than the cost of their construction.
Well, I've already spoken about the cost of construction, Nuwan. I think we've already covered that material.
Okay, that's all my question.
Thank you. Mr. Kraus?
Just with the leases, are these, I'm unfamiliar with assisted living leases. Are they longer term? Like it's not just a year-to-year basis?
No, it is a year-to-year.
It is a
basis,
year-to-year.
Yeah, it's not a life lease.
Right.
So they're not independent and they make their own meals and things. It's where they have an ownership, not ownership, but a life interest in their unit. This is standard rental, just they get all of these services. So they pay a very significant amount of rent,
Right.
which takes into account 3 meals a day, housekeeping and laundry and all of these.
Do they have to, is it staggered? Like, can you just have the basic rent and then buy add-ons? I've heard of that. Or is it all included? It's like, if this is the one rent and you have to buy into all these.
You know what, I don't want to categorically say for this one, but I believe typically they are all inclusive. Like laundry may be a separate item or something like that, but typically you get all of your meals and all the housekeeping.
And is it a 55 plus? It's not a 55 plus, it's assisted living, right?
It's assisted living,
Okay.
Yes.
Okay. And do you know any other factors that might be affecting that vacancy rate, right? Like, or is it just that you've got a small market share that has got that money at that age to invest and pay that much? Or is there something else? Do you know if there's something else going on in that situation?
That's part of it,
Okay.
but location can have a big impact too. I know in many cases, people want to stay close to home, where when they move into assisted living, so as well as the degree, the competition for this is relatively large in Southwest Winnipeg. There's a lot more of them.
New builds, or is
well,
it been
new builds
historically,
and
or is it
other
just really
assisted
a lot
living.
has come onto the market recently?
Some has come onto the market, certainly, but there's also ones that are arguably in better locations. This is behind a strip mall off of Pembroke Highway in a marginally lower economic area than some areas of Southwest Winnipeg. We have Lindenwoods, Tuxedo area off of not Chancellor Matheson, I'm forgetting the name of it now. We're over by IKEA, there's the crossroad there. There's a number of assisted living centers down there. So location has a big impact. It just does not seem to have the draw that they originally thought it would have.
Thank you, those are my questions.
Thank you. And Mr. Purvis.
I have a couple of questions, I think along a similar line to Mr. Kraus. Looking at the graph on 18, and it shows apartments, seniors housing, and care properties.
Yeah.
This property would be more in that green line, that seniors housing,
It would be, yeah, it would essentially be more,
or between the
it would not be the top line or the bottom line, it would be in the middle there, certainly.
okay, because a care property would be one that actually has like nurses and
That's correct.
hospital-esque facilities and stuff like that.
The medical services, certainly,
Yeah.
yes, yeah.
And my other question with this is, it was purpose-built to be a seniors, like an assisted living facility?
It was, yes.
I'm just curious about all the parking then, because other assisted living facilities that I've come across in my life and even through these hearings, they don't have a lot of parking, because usually when people are at the stage where they're no longer wanting a kitchen, they're not prepping their meals, they're also not driving anymore. So I'm just curious why they put that much parking in.
So, and that may be, I don't have this directly from the owner or anything, but if you look at the marketing for the property, and I didn't provide it in my brief, but if you look at the city's brief beginning on page 15, they've kind of marketed it towards a more independent type of senior than you may typically see in independent assisted living, where you know you're a little bit older or a little bit less able, etc. If you look at the amenities there, they have what they call the jazz club, the Blue Note Club and Bistro. These are not, of course, places you and I can go to and have a meal. It's not a restaurant. It's just what they call them internally, the Fireplace Lounge, Diva's Salon and Spa. So they're kind of marketing it to, or wanting to market it to a more independent, maybe marginally younger, so that may be why they have slightly more parking. But I think at that age, you have a lot more options as to where you might want to live and be able to live before moving into assisted living. So there's kind of a delta there between what it's aimed at and what the market is, perhaps.
Okay, and the photos that we saw, there was some, you said some have the full kitchen, others it's a little bit more, the assisted living facilities usually have like very minimal in the unit. It's sort of
That's right. Yeah, typically they will have
fridge and a microwave.
Either nothing or a kitchenette type of idea, such as the one shown on my page 10, where we have it shared between the two units now, where they only have a bar fridge, a microwave, and a sink. Now, in this facility, they do have arranged in that some of them are like that and some of them have a kitchen more as shown on page number 8.
Okay, so is it mostly the bachelor ones that have these, or the studio units have these kitchenette style things? And then the other ones, the 1 and 2 bedrooms would have a full kitchen, or like what's the blend?
So no, not necessarily. So if you look on my page number 3, the studio units, so all of the studio units, 20 of them, and half of the 1 bedroom units, so whatever that figure is, 26, 27, are designed with shared kitchenettes and laundry facilities as shown on that page. So it's a fair number. It's, call it roughly half of the building. Well, actually probably slightly more than half of the building would be, no, exactly half of the building would be those shared kitchenettes and laundry facility. So
Okay.
not a full kitchen.
And then page 8 would be the other half that.
Page 8 would be the other half, yes.
And then, okay, I think I've got a better picture of just, yeah, it seemed to have elements of, yeah, it's a little bit more of a blend of a sort of a 55 plus building and then an assisted living. It's sort of a bit more of a blended building, I guess.
Well, so it's not 55 plus, but yes, I take your point in that they're kind of aiming at maybe a more active market segment of that upper seniors population. And as I said, I think there's, if you're in that category, you can still, move into a life lease and do all of your, be more independent or buy a condo or to downsize or rent an apartment or any number of things, right? Before you need to move into assisted living. So there's a bit of a discrepancy there, I guess, is how I would state it.
Okay, thank you.
Just a couple of questions, Mr. Smith. In regards to these, I'm going to say unusual units, the studios and the 1 bedrooms or half of the 1 bedrooms that have these kitchenettes, would you say that's not typical of these buildings?
Not typical, yeah. Definitely not typical in an assisted living. Yeah, I haven't seen it in any other location where you would have a shared facility such as that. I haven't encountered it in my career.
Okay. And do you happen to know the square footage on the studios and the 1 bedrooms?
Unfortunately, I did not get a floor plan that had the breakout of the sizes, but typically they are generally somewhat smaller than a standard market apartment. That's just how they're designed. Typically they don't, you want to downsize and not bring everything with you into an assisted living. It's, I think, what they tend to find.
Right. Okay.
They fit more units on the site as well.
And you also mentioned about the vacancy, the 62% vacancy, and you stated that 61 of these apartments are vacant. Would you happen to know which units are vacant? Would they be the studio, the 1 bedroom, or the 2 bedroom?
I wouldn't know off the top of my head, but I think, well, I didn't include the rent roll necessarily, but I think the city may have, and you could likely tell from the figures there whether they are 1 or 2 or studio.
That's fine. I was asking more out of curiosity, simply because of this shared kitchenette space.
Right.
Anyway, thank you. That's all my questions. Does either party have a wish for a summation?
No, thank you.
No, thank you.
Okay. I think at this time, we're just going to take a quick 7 to 10 minute break. I thank you. I would like to call this hearing back to order. We are going to be looking at item number 5 next, which is the last item on the docket, 45 Bolton Bay. Again, we are looking at assessed value. And Mr. Assessor, whenever you are ready.
Thank you, Madam Chair. File number 24-3692, roll number 120-9761-9700. Address is 45 Bolton Bay, roll year 2025, reference date April 1st, 2023, assessed value 14,091,000, classification 20 residential, liability taxable. This is a 4-story building. Actual build year 2006. Unit count 94. No indoor parking, just 25 outdoor parking. This is also a assisted living facility. So this everything's what I said, the first property apply for this property. So that means we assess this as a normal apartment. Page 2, location and aerial picture of the building. This is not a bad location. And page 3, request for income information, and also you can see the subject property sales history. No sales for that property. This property. Sorry. Page 4, income value summary. You can see 64 1-bedroom for this apartment and 30 2-bedroom. In total, 94 units. Average monthly rent per unit, 1,157. Gross potential rent, 1,305,942. Vacancy rate, 3.4. Effective gross income comes at 1,261,540. We have used 45.27% expense ratio. Net operating income comes at 690,441. We have used 4.9 capitalization rate. Based on the capitalization rate, market value comes out at 14,991,000. Market value per suite 149,904. Page 5, you can see rent comparables. And page 6, CMHC rent calculation. And page 7, you can see when I'm comparing to the market rent, that's like 13.45% lower than the market rent. And in that page, you can see I add one sale. Actually, it's the same year build, but it's an old sale. It was sold in 2016. That supported our unit value. This is not like direct comparison, just ballpark to show our assessment in line with the market. And I'll jump into the page 9 first and come back to page 8. Page 9, capitalization rate. I think this is a model generated capitalization rate, and you are familiar with this chart right now. Page 8, capitalization rate evidence. This is the sales occurred in previous years. So the building was built in 2006 and it has 94 units. The model cap rate is 4.9. I believe 2390 McPhillips Street supported the model cap rate. Page 10, Municipal Assessment Act excerpt. page 11, exterior picture of the building. Page 12, interior picture of the buildings. And it's nicely maintained, like good quality building. And page 16 and 17, CMHC rent chart. Page 18, income and expense information, page 18 to 29. So I believe 14,091,000 is fair value for the property. This is end of my presentation. Thank you.
I thank you. Any questions, Mr. Applicant?
Just one really, but if we can keep them, we can carry forward my questions from the other ones. They kind of apply to this as well. I do have one question. So the capitalization rate that is used here of, what was it, 4.9%? That is a model generated rent?
That's right.
Okay, and on page 9 of your brief, just bear with me quickly here, second paragraph. So it states for the 2025 general assessment, cap rates were derived from model generated estimates of net operating income and sale prices that were time adjusted to April 1, 2023. So does that mean that the model is using estimated NOI and adjusted sale prices on transactions that have happened in the model in order to come up with the capitalization rates that are applied? That is what I have been told in prior hearings by assessors, that is accurate. That is how the model functions. Is that correct?
I think so.
Okay. Those are all of my questions. Thank you.
I thank you. Mr. Kraus?
I have no questions at this time. Thank you.
Thank you. And Mr. Purvis?
Not terribly important. The photos that are in your brief, are those from a website or did you do an inspection?
Actually from website.
Okay. And did you do an inspection or?
No, I didn't.
All right, thanks. That's all my questions.
Thank you. And just one question, just for clarification. I understand your cap rate is model driven, but your brief is also model driven, correct?
Yes, correct.
Yeah. Thank you. Mr. Applicant, if you would like to proceed with your brief.
Thank you, Madam Chair. So 45 Bolton Bailey, this is also an assisted living facility. And as already stated, it's built in 2006. It actually has a total of 95 units, not 94. And the suite count is different than what the city has as well. So this is confirmed by property management for the property. So the city has 64 one beds and 32 beds. If you look on my page 3, there's actually 2 studio apartments, so no bedroom. 63 one beds and 32 bedroom units. So slight difference there, obviously. But that is the correct breakout for the property. Photos are on page 4 and 5 onwards. Again, it's assisted living, so there is essentially a main floor of space that is common areas, dining room, kitchen, library, lounge, exercise room, all of those things. And the site and location are shown on page 7 and 8. It is on page number 8. You can see where it's located, off of Kenaston on the right-hand side. So as you drive north on Kenaston and pass Taylor, there's the a small portion of the former military base on the east side. And then there's a number of apartments that are on the right, again, east side of the property of the Caniston as you move north. That's where this is. It's in behind those towards where the rail line is. So that is the location of the property. Again, we are dealing with assisted living, so we can't use their in-place rents as evidence of what they would rent for on the open market, as they include services. So again, we're looking at what should they transact for on the market. We are not, again, disagreeing with the city's projection of the rental rates for the subject property in this instance. So we are in agreement on that. We look at vacancy moving forward on page number 11. We have the CMHC stats again for standard market apartments renting above $1,300 a month, which, bear with me. And then newer built apartments, and you can see the vacancy rates for all of those. Subject property, and that was built in 2006, so this isn't a lease-up issue. The subject property had over $92,000 in vacancy in the relevant year, which would be roughly 7% or so vacancy. That is an ongoing issue essentially with this particular property. We have elected to not use their actual vacancy in the valuation, but defer to the city's 3.4% allowance. And then again, take that into account in the selection of the capitalization rate as one component of the capitalization rate, again, consistent with appraisal theory. So it has greater vacancy, but we are not allowing for that vacancy within the vacancy calculation. Expense allowance, we've done a 3-year stabilization at the bottom of page 12. You can see how that was done. If you look at the stabilized column, so typically we're looking at 3-year averages here, with the exception of property tax, insurance, and property management. We use the actuals for insurance and property tax, and a projection of 5% of effective gross income for property management. Obviously, that brings that particular number down quite considerably from what it is internally. Again, it's a business, assisted living business, so that figure is going to be higher than if it was just operated as a standard market apartment. So we made that adjustment, brought it down quite dramatically. There may be some slight reduction that one could look at for, say, water, sewer, and electricity when you take into account the kitchen, things of that nature, cooking, etc. But it's not a significant amount, and we don't have any definite way of making that adjustment. So we've done a 3-year average for those as well. This produces $656,345 in expense allowance. Now, if you use that figure, that would be just over 52% of effective gross income. That is probably on the high side. Certainly, there are apartments that are out there that will have that, and we do have a property that has, again, significant common areas that you wouldn't have in a standard market apartment. So they would have a higher expense ratio and amount than you would see typically. But again, for the purposes of our evaluation, we are going to defer to the city's lower projected expense allowance of 45.27%. So the expenses are higher, but we're not taking that into account in the expense allowance. But it should be kept in mind in the overall frame. All of my capitalization rate discussion with regard to assisted living facilities and why this cap rate should be 6% are identical. I'm not going to repeat that. All of that information is the same. And again, we have a significantly rising interest and mortgage rate environment as of the valuation date, which also needs to be addressed. So we have, as shown on my page number 19, summarized our valuation. We have deferred to the city's revenue projection. We think that's probably in line with the subject. We've deferred to their vacancy rate. Actual vacancy is about double that, but we have deferred to that. We are taking into account that additional vacancy risk, again, in selecting the cap rate, consistent with theory. And the actual expenses were $656,345 when you stabilize them versus the what we have allowed of $571,099. So in each instance, we're being conservative in what is being applied to our valuation here. And that is also true for the capitalization rate that we've selected. We could be higher than that, but we're taking into account all factors. So 6% is certainly a very reasonable figure to apply to this. We could be more aggressive than that. So our final market value based on this information is $11,507,000. And again, I would point you to 475 and 490 Lindenwoods Drive in the addendum materials. That is my presentation. Thank you.
Thank you. Any questions, Mr. Assessor?
One question. I want to confirm the suite count because I can update that information. Mr. Trevor Smith, did you confirm that with the property manager?
I did, yes.
Okay. Can you repeat that suite
Sure,
count?
it's in my brief there on page
Okay, sure.
8, but it's 95 units, 2 studios, 63 one-beds, and 32 beds.
Okay. Okay, thank you. That's all my question.
Thank you. And Mr. Purvis, any questions?
Just one. I didn't see any photos of kitchens, kitchenettes. Is this one, like, how's the layout of these units?
Unfortunately, I did not have the opportunity to do a walkthrough of this particular one, given time constraints. It's a new one to me, so I did not get the chance to take those photos. So I couldn't give you the specific layout, unfortunately. But in talking with the managers, it's not untypical of assisted living facilities. Typically, they are slightly smaller, etc.
Okay, that's the only question I had.
Thank you. And Mr. Kraus?
So do you know if these have shared kitchens?
No, they wouldn't have shared
So this is
kitchens.
more of
I've
a
never seen
traditional-
that anywhere else other
Okay.
than that one that we just
Okay.
covered on Chancellor.
Okay. And then my other question would be, this one also has a higher vacancy rate. Is it, I guess, is it an industry, understood in the industry that assisted living builds have generally a higher vacancy rate just because they're harder to fill?
I think it varied.
Okay.
I don't want to categorically say that, they have higher vacancy, but they have turnover for different reasons, right? People move out for needing greater care or end of life situations, etc. Right. So, but when they're in there, they tend to stay in there and not move until they need to.
Okay, thank you. Those are all my questions.
Thank you. I just have one question, and it's more out of curiosity. It's agreed that these do not operate like a typical apartment building, being assisted living and having all these additional amenities, correct?
Correct.
But what about all the staff that comes with those amenities?
Yes, that's not included if you're looking at the expenses. Is that what you're
Exactly.
referring to?
No, But I'm just saying that
So,
it's not a consideration, but to me, isn't that something that also again points to the fact that these are not like a typical apartment?
it does certainly, and if you review the income and expense statements, it takes into account the whole business, so you'll see large figures for,
Right.
staff salaries, et cetera, which obviously we don't include in the expenses in our analysis. All of that is stripped out down to
Right.
what normal costs are for an apartment structure.
All right, thank you. Does either party have a wish for a summation on this property?
No, thanks.
And Mr. Smith, you're good. I'm sorry, I didn't hear you.
Yeah, no, thank you, Madam Chair.
Thank you. All right, we have heard out all the items on the agenda this afternoon, and this hearing is adjourned. And I would like to thank the city assessor and the applicant for their briefs and their time on this very cold, blustery day.
Yes, well, thank you all for your time and patience as well.
Thank you.
Stay warm.
Yeah, thank you, everyone.
Thank
Thanks.
you.
Thank you.